Welcome to this explainer. Look, if you're navigating the Indian stock market, you've definitely seen NSE and BSE flashing constantly on your screens. Today, we're going to cut right through all that noise and look at the actual mechanics behind these two absolute titans of trading.
Even seasoned traders sometimes pause for a second when they see the exact same stock listed twice on their brokerage app. It's a classic dilemma. Which one offers better liquidity? Is one actually, safer than the other? Let's clear all that up right now so you can trade with total confidence.
All right, here's our roadmap for today. 1. The stock market concept. 2. Meet the giant exchanges. 3. A head-to-head comparison. 4. Answering your burning questions. 5. Busting common exchange myths. And 6. What really matters. Let's dive in.
Section 1. The stock market concept. What is an exchange?
Okay, so you already know an exchange is a highly regulated marketplace. Think of it simply as a massive, hyper-organized supermarket. But instead of groceries, you're buying and selling pieces of real businesses. Equity shares, ETFs, bonds, the whole shebang. It's literally the essential plumbing of the financial world.
And here is the absolutely crucial point. In India, both of these major marketplaces operate under the strict, watchful eye of the Securities and Exchange Board of India, or SEBI. That means whether you use one or the other, they are both bound by the exact same strict national rules. They're designed from the ground up to protect you, the investor.
Section 2. Meet the giant exchanges. BSE versus NSE.
Let's introduce our heavyweights. The Bombay Stock Exchange is the true heritage titan. Established way back in 1875, originally gathering under an actual banyan tree in Mumbai, it proudly holds the title of Asia's oldest exchange. On the flip side, the National Stock Exchange is the 1992 modern disruptor. They're the ones that dragged the Indian market into the future by introducing fully electronic, screen-based trading in 1994.
Now, the BSE is anchored by the Sensex. That's their benchmark index, tracking 30 heavyweight, well-established companies across various sectors. So when the evening news reports that the market is up, this 30-company collective is usually exactly what they're talking about.
Meanwhile, the NSE relies on the Nifty 50. It tracks 50 major companies. And honestly, this is the barometer most active traders and daily financial news channels absolutely obsess over day in and day out.
Section 3. Head-to-head comparison, comparing the titans.
So, just to recap real quick, the BSE has the deep historical roots and the 30-company Sensex, while the newer NSE has that digital native DNA and the 50-company Nifty Index. But how does this actually translate into your daily trading experience?
Well, historically speaking, the NSE handles a vastly larger share of cash, equity, and derivatives trading volumes. Higher volume means incredibly high liquidity, which is exactly why active, high-frequency algorithmic traders flock there like bees to honey. But don't count the BSE out. It remains a massive hub for small and medium-sized enterprises, actually boasting one of the highest total numbers of listed companies anywhere in the world.
Section 4. Answering your burning questions, clearing the confusion.
So you're looking at your screen, and you notice a stock is priced slightly differently on the NSE versus the BSE at the exact same moment. Is this normal? Actually, yeah, absolutely. Buying and selling activity is happening completely independently on each platform. But here's the cool part. Professional arbitrage traders instantly spot these tiny gaps and trade on them, which naturally forces the prices on both exchanges right back into sync with one another almost instantly. Because your shares are held centrally in a digital demat account these days, cross-trading is theoretically totally possible. But, and this is a big but, executing a buy on one exchange and a sell on the other depends entirely on your specific broker's internal systems and their settlement rules. A lot of them do allow it, for sure, but you should always double-check with your broker first.
Section 5. Busting common exchange myths. Fact versus fiction.
Let's clear the air and bust some myths. First off, NSE is not inherently safer. They both answer directly to SEBI. Second, returns are absolutely not higher on one over the other. The underlying business drives your returns, not the platform you bought it on. Third, no, you do not need separate demat accounts. And finally, the BSE isn't just some legacy platform for older investors. Both are actively used by massive institutions and everyday retail traders every single day. Section 6. What really matters? Focus on the basics. For retail investors like us, both of these platforms are excellent. They're reliable and they're highly regulated. So honestly, agonizing over which exchange to use is just a massive distraction from your actual job as an investor. The exchange
It's just the plumbing. The truly important decision, the only decision that's actually going to build your wealth over time, is choosing the right company at the right valuation according to your own financial goals.
Before you ever even think about hitting that buy button, you should be marching through these crucial steps and just completely ignoring the exchange until it's time to actually execute. Ask yourself, is this business fundamentally strong? Are the earnings sustainable long-term? Is the current valuation reasonable? That is where your true edge as an investor is found.
Ultimately, long-term wealth is built by holding quality businesses, not by obsessing over which exchange executed the trade. So I want to leave you with this thought. If the exchange is just the plumbing, are you spending more time worrying about the pipes or the actual quality of the water flowing into your portfolio?